We're joined by Art Hogan, Chief Investment Strategist at B. Riley FBR. Art, as we record this, we are down 1,500 points on the Dow. It's like an auction right now on the way down. The market is still open. That's what we're recording this about 3:10 p.m. Eastern time on Monday afternoon. We don't know by the time this is posted what the futures will indicate. However, what do you make of a 2,000-point drop over 2 trading sessions?
Yeah, it's amazing. And the amazing part is we forget how fast markets come down, right? So we looked at January coming into last Friday, up 7%, and just acted like that was normal. It's not normal. We were too far too fast. We're starting to get concerned about interest rates and where they might be heading. And once stocks start selling like this, it's very difficult for anyone to get in the way, right? So, with whether it's ETFs or programs or, machine trading and algorithms, it happens quickly. And, obviously we're going to find a level at which this bounces, but it's not going to be today.
The one thing that I've talked about with guests on Power Lunch extensively over the last few months is how concentrated this market is. In other words, if you look at the top 5 ETFs for equities, they have the same 5 stocks in them, basically: Apple, Amazon, Facebook. I worry that the market, because of passive investing, might be a little top heavy. Do you think there's anything to that? If there's not, tell me. But otherwise, it seems like this market is being sold entirely en masse without regard to equities, which leads me to believe it's sort of the big cap stocks which are pulling everything down.
No, I agree wholeheartedly. I think that that concentration has been with us for a while. It just continues to get worse and worse. So whether you're in the S&P 500 or any one of the ETFs that has those 4 or 5 names that are so heavily weighted in all these indexes, I think to really play this out, when you think about, we're concerned about rising interest rates and financials are being sold off. So obviously this is en masse, agnostic, 2-sector selling. It's uncharacteristic of what we should be thinking about in terms of better economy, better earnings. But while it's happening, no one's going to stand in the way of this freight train. And I think you're right. I think, to that point, this year, the S&P 500 is up two times as much as the Russell 2000. That makes no sense, except and unless you start to think about that concentration at the top.
What do you think will stop it? I mean, it's not humans at this point, it appears. I mean, the rapidity of the decline, Art, makes me think that computers are at work, and that's the way the market is structured now. So that's fine. But when do you see any kind of a bottom, a slowdown, a stop selling? What's it going to take?
Yeah, we should probably hit at least a caution flag at the 100-day moving average. We tested the 50-day today and failed, both on the S&P and on the Dow. NASDAQ didn't quite get there. But I think that, as that breach of the 50-day moving average pushes down to the 100-day moving average, you're looking at, significantly lower levels than we are here. But I think that's where the caution flag comes out and people start to take notice. If that holds, then that could be your bottom.
How about this,
the way the market's selling?
Art, I know that we're taped right now, okay? And the viewer knows that. Here's the thing. In the time that we have been on together, which has only been a couple of minutes, the Dow is down a 350-point round trip. We're now down, quote, only 1,100. We moved 350 points in the matter of one question and one answer. Is that a healthy market? Is that a sound market?
No, it's not sound at all. That's irrational volatility, and we're not in a rational phase of the market right now. Right now, we're in that irrational, as you mentioned, agnostic of vertical selling, and it's largely machines and ETFs. When that stops, some rationale will come back into the marketplace and say, wait a minute, we sold off this sector, which does better in a rising interest rate environment. We're just not there yet. We may get there sometime this week, but right now we're in that selling crescendo.
Do we need to hear from, today's the first day of the new Fed chair, Jerome Powell, who's already talked that maybe if we were going to get 4 interest rate hikes this year, it's now 3. If we were going to get 3, maybe it's 2. Do we need to is there anybody that would calm it? Do we need to hear from the president, from the Fed chief, anybody? Or just let the market be the market and let natural buyers come in?
Yeah, that's exactly correct. I think people step back and say, wait a minute, we've done too much, too fast, to the downside, and buyers will come back. There is no J.P. Morgan, of old that will step into this market and say, okay, calm down, everybody. There is, this is a market that's going to find a level, find some stability, and, by the end of the week, we'll probably have found that.
Art Hogan, Chief Investment Strategist at B. Riley FBR. Art, thank you for joining us on what is a truly dramatic day here on Trading Nation. Thank you.
Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.